let's project the rest of the income statement. What we're going to do is we're going to look at the percentage of sales that each line item has been and look at trends, talk to management, and see what we think the percentages should be going forward. Okay? All right, and we'll start with the number 2 line item. Let's make sure this clock is ticking on our... Yes, we're working, we're good. So let's look at the second line item, which is cost of goods sold. So here is Apple's cost of goods sold, and we see that 60.62% in 2010, 59.5% in 2011, and 56% in 2012. So Apple has been bringing down their cost of goods sold. Okay? It's gone from 60.6% to 56.13% in the last 2 years. Can this decline be sustained? This is a good thing. Cost of goods sold, remember there's a relationship between cost and price. Either prices are going up or costs are going down or some combination thereof. How do we lower cost of goods sold as a percentage of sales? Well, we got our checklist. Here are the typical items that we look at as analysts to see how companies are lowering their cost of goods sold as a percentage of sales. Well, the first thing we're going to ask is, are you getting volume discounts on, from your input suppliers? So if you're building a product, if you order a higher volume of units from your suppliers, will they give you a price break? Volume discounts. Have your commodity costs gone down? What do I mean by that? Well, let me give you an example. Tyson Foods is in the business of raising chickens. Okay? What is the single most important or most consequential cost of raising a chicken? Corn. Let's say that the weather is perfect. It's not too hot, not too cold, not too dry, not too wet. We have a bumper crop of corn. What happens to the price of corn? It goes down. That's a good thing for Tyson Foods. Their profit margins will rise. Okay? Maybe we go around the world and we find cheaper sources of inputs. Be careful when you do that. Make sure that we're not buying from countries that pollute the water, pollute the air. Make sure we're not buying from countries that put 10-year-olds to work at 10 cents an hour. Okay? We don't want slave labor. All right? But can we find cheaper sources? Maybe our engineers have made a design change in the product, or maybe they have found new technology that is cheaper, enables us to get done what we want to get done, but more cheaply. Maybe we can assemble the product more cheaply because they've changed the design. These are common ways we can lower the cost of goods sold. Another possibility is lower labor costs. We can lower our labor costs through job cuts, maybe through labor agreements. Watch out for those unions. Can we negotiate with the unions? Okay. Can we let a few people go and still produce the same number of units? Maybe we can outsource. Okay. I talk to a lot of Governor's Cup teams. The Governor's Cup competition, business plan competition, they'll come to me and they'll say, I'll say, how much money do you need? We need $1 million. Okay, what are you going to do with it? We're going to buy a piece of land, we're going to build a building, we're going to buy a bunch of equipment. And I say, stop the press. Have you considered outsourcing? What is that? Well, there are companies that are out there that are in the business of making the product that you design. Now, you might not be able to make it as cheaply through an outsourcer, but before we get into a brand new business with no track record, let's not borrow or ask for $1 million. How much money do you really need? $100,000 to get the process going. We're going to outsource the manufacturing to someone else. Once we get up and running and you prove that your product can be sold at a high enough volume, then maybe we come back and build our own. Okay? Now the opposite of outsourcing is through automation, economies of scale. Once we're up and running and we prove that there's a market for our product, maybe we can buy more equipment and we can operate more efficiently and we can produce units for less per unit. That's called operating efficiencies or economies of scale. Okay, so two extremes, outsourcing or operating leverage. Okay, check that company, see if they're buying property, plant, and equipment. Okay, to see if the company's been investing. All right. Lastly, the last thing we'll look at on our checklist of how to improve our gross profit margin, which means lowering our cost of goods sold as a percentage of sales, is maybe changing the mix of products and pricing. Okay? So with Apple, they come up with the Apple Watch, the Apple TV. How does the pricing and the cost compare on the Apple Watch and the Apple TV to the iPhone and the iPad? Are they more profitable? Are they less profitable? Okay? Anytime a company comes up with a new product or service or makes an acquisition, one of the first questions that an analyst will ask is, how does the gross profit margin for the new product or service or the new acquisition compare with your current gross profit margin? And remember, that gross profit margin is your gross profit, which is sales minus cost of goods sold equals gross profit divided by sales. So in other words, what is the relationship between cost of goods sold and pricing? Okay? All right, and if the new company or new product or service has a higher margin, that's a good thing for the company. All right, will their prices be higher or lower relative to their costs? What will their margins look like? Okay? So how will a product mix affect the company's gross margin and operating margin? All right, so let's look at cost of goods sold. So again, we see that's gone from 60.6% to 56.13%. Okay, so we see our average is 2.25 percentage points per year. So on average, it's gone down from here, 2.25 percentage points, another 2.25 percentage points. We talk to management. Management does not feel comfortable with another 2.25 percentage point reduction. They don't think they can get there, but they do think that they can lower by 1.5 percentage points. So we'll take our 56.13%, subtract 1.5%, and we come up with our forecast cost of goods sold percent of sales. We multiply that by our sales number of 211, 286, our forecast sales, and we come up with cost of goods sold of $115,426 in 2013. There's our cost of goods sold. Okay? This level of cost of goods sold results in a gross profit of sales minus cost of goods sold. There is our gross profit. Here's our gross profit. All right. Moving on to the next line, SG&A. Tell you what, that's our break point here. Is that our break point? No, it's not our break point. We're continuing to go. We're going all the way to 31. All right. Moving on to SG&A. Okay. All right, so here's SG&A as a percentage of sales, 8.46% down to 6.42%. So over the last 2 years, the company's been able to reduce SG&A as a percentage of sales a little over 1 percentage point a year. Okay, we talked to them. They plan to introduce some new products in the next couple of years. They think they're going to need some new sales people out there. So they think they can push SG&A down, but not by 1%, maybe by 0.5%. Okay, that's what they're comfortable with. And so we're going to take the SG&A percentage of sales in 2012, take off, reduce it by half the rate that they've been reducing it by, and we get 5.91%. Okay, and this translates into SG&A of 5.91% times sales of $12,487. Okay, moving down another line, we'll look at depreciation. Okay. So here's depreciation as a percentage of sales. It's actually gone up. You know what that means? They have been spending more on property, plant, and equipment. Okay? The spending increase on property, plant, and equipment has outpaced the sales growth. That's what this means. Okay? So this is related to PP&E. PP&E is related to cost of goods sold. If we're going to have higher sales, we have to produce more units. To produce more units, we have to have more property, plant, and equipment. Hopefully the new equipment will produce each unit at a lower cost, so cost of goods sold as a percentage of sales will go down. That is economies of scale. We invest more in order to produce at a lower price per unit. Okay? As PP&E goes up, depreciation will also go up. Over the last 2 years, depreciation has gone up an average of about 0.25% per year, percentage point. Okay? Management believes this is a reasonable expectation, so we're going to tack on another 0.25% to our 2.09%, and we come up with 2.35% as our percentage of sales in 2013. We'll multiply that by our sales number, and we get $4,965 worth of depreciation in 2013. Okay? Let's go down to the next line item and look at research and development. Okay? So here it is. Notice that research and development has been going down, 2.73% of sales, but spending has actually gone up. This means that sales growth has outpaced the growth in research and development. But we spent $1.8 billion in 2010 on research and development, and we spent $3.4 billion in 2012. That's a lot of money on research and development. Okay? So R&D as a percentage of sales has declined by about 0.3% per year. And so we have to be mindful again, sales have increased significantly. So even though the percentage of sales has gone down, the amount that we're spending on R&D has gone up. In fact, it's doubled. R&D has doubled in the last 2 years. Okay, so we're still spending a lot. So management expects to spend about the same percentage in 2013 on R&D as they spent in 2012, and so we're going to multiply the 2.16% by our sales forecast, and we're going to spend about $4.6 billion on research and development in 2013, so it goes up nicely along with sales. All right, so our operating profit is projected to be sales minus cost of goods sold, minus SG&A, minus depreciation, minus research and development, $73,845. And that's in billions, but we'll just leave it in thousands here. Okay? Let me stop and just say, if we were going to forecast the entire income statement, our next line item would be interest expense. Okay? But our goal is not to forecast net income, it is to forecast operating cash flow. Okay? So we do not include interest expense in our calculation. Okay? If we did, we would consult the footnotes of the financials to see if any principal is scheduled to be paid off in 2013. We would also talk with management to see how they plan to fund spending on assets in 2013, and then we would multiply the total balance of debt by the interest rate to derive our interest expense. Okay? But we are not going to do that. We're not looking at interest expense. We are not looking at debt right now. We'll get back to debt in just a couple of slides. Okay? So let's move on. Let's look at taxes. So taxes as a percentage of, this is really not a percentage of sales, this is a percentage of pre-tax income. Percentage of pre-tax income. Okay? So remember that the Congress determines tax rates, and the new administration has just reduced corporate tax rates, so we're going to use that tax rate, the top tax rate of 21%, and we're going to multiply our forecast operating profit by our tax rate to get our tax expense in 2013. Okay? And we now can forecast our projected operating cash flow. We're going to take our EBIT plus our depreciation minus our taxes, and we get our operating cash flow. This is the cash inflow that we expect to generate in 2013. Next, in the next clip, we're going to project our cash outflows on working capital, accounts receivable and inventory, and on property, plant, and equipment. And we will subtract the cash outflow from our cash inflow to get our free cash flow. And that is what we are valuing. That's what we're buying. Okay, we'll do that in the next clip. Let your brain simmer down a little bit, cool down. Peace out, shalom.